Buen día, bienvenidos a todos.
Welcome you all. You are most welcome. We are proud and happy to have you here with the new edition of the Money and Banking Seminar of the Central Bank of Argentina in this spectacular room. And I'd like to share with you that the Money and Banking Seminar is an event that attracts 300 to 400 people, but this year we had to limit the number of people who have registered to 1,700, which is the maximum capacity of this room. This doesn't mean that they all will be present at the same time, but I'm so happy to have you here with our agenda in place. The underlying idea of these ideas is to put a brake on the speed of everyday affairs and find an environment where we can think about our economy with a broader perspective, trying to learn new things. And in an effort to create an environment that would be intellectually fertile, we try to have participants who share insights with us from different angles, answer questions, why have we reached again a situation of high inflation? What about the experiences of other countries that are relevant to Argentina in the context of declining inflation, and also what we can expect from our economy if we remove fiscal deficit and reduce inflation in a sustained fashion. Let me share with you how we do think about the structuring of the different topics and participants, speakers. First, we chose fiscal deficits, monetary policy, and inflation. Fiscal dominance is at the heart of the stage, at the center of the stage, and one of the key points of the economic program was to anchor inflation expectations vis-à-vis fiscal deficit and how to tackle it from the government, because we were discussing about the sustainability of the fiscal balance, and it is very rare for us to see that we are not fulfilling with that. We are fulfilling those goals, and we have also anchored inflation expectations. So, over the first 7 months of the year, expected inflation, according to REM, the Central Bank Market Expectation Report, was declining, and it was always higher than what we could observe and notice. The intention is not to say that fiscal dominance is the center of everything, because we have to think that over the last 20 years, every year, the central bank provided financing to the treasury, even in years of primary surplus, more than 60% of monetary emission. Only in the last 4 years, the central bank provided funding for 22 points of GDP. Cleaning up the balance sheet of the central bank reverses these capital flows, and for the very first time, the treasury is contributing to improve the balance sheet of the central bank, and it shows a contractionary element in the money supply, as announced by the Nobel Prize winner, concerning the relevance of institutions, how important they are and significant for economic development. So we are laying emphasis once again on institutionalization, which is of the essence, and we are celebrating that today we have made that announcement. And going back to the different panels and speakers, presenters. We are very proud of the presenters and speakers who have accepted this invitation. That is to say, to combine policymakers on the one hand, allowing us to learn from their experience, combining that with academics that help us understand all these concepts and design ex-ante tools as the development of our programs is showing us more challenges. And on top of these experiences, decision makers from the private sectors, especially from the financial sector. As regards policymakers, we have a panel on current policy economics with Neel, Kashkari, and Pablo de Cosa, and then two policymaker panels thinking about the implementation of the implementation program. Leo Liederman and Gustavo Franco on Brazil and Israel, and another panel with Adriana Almas and Gerardo Licandro, Peru and Uruguay cases, which have a very important element with bimonetarism, with dollars, because both societies, when the stabilization programs started, they were thinking and saving in dollar terms. 3 academic panels, 3 fiscal dominants, Ivan Verning and Juan Pablo Nicolini, and a panel by Greg Makoff with financial dominance, which has to do with government indebtedness and the impact on policy design. And the third element here, 2 panels, decision makers, international investors, Claudia Gauges, Bank of America, from Stock and Stock from MetLife, and participants from our local financial systems, Fabián Con from Banco Galicia, Jorge Verler, BBVA, and Osvaldo Jiménez, Mercado Pago. And just to combine these 3 axes, we have 2 more panels on a cross-sectional way, analysts and academics and experience in real economy, monitoring the decisions made by policymakers in the field of economic policies, Ricardo Ariazo, Gustavo Cañonero, and Rafael Di Tella. And in closing this program, Ivan Verning, the Deputy Governor of the Central Bank of Argentina, who is the official note-taker of this event and will share us with takeaways, will give us a closing speech. And out of agenda, I have something to share with you that tomorrow afternoon, President of Argentina, Javier Milei, will come here because he accepted to come here and make an off-agenda invitation. He accepted the invitation some time ago. But of course, we wanted to somehow maintain the confidentiality vis-a-vis the original audience, and we wanted to be absolutely sure that we're going to keep it a secret, and now we are disclosing it publicly. And before starting with the panel sessions, I have a couple of housekeeping matters to share with you to make this experience much richer in this case. Whenever panels have speakers that are not fluent in Spanish, panels will be conducted in English because everyone may understand better, make the most of the panel, and have translation services if needed. I want to thank speakers. First, international speakers, because they have traveled extensively and intensively to come to Argentina. They are interested in our country, and we hope that this experience will be very useful and profitable for you. So for us, it's very valuable to have you here, and also those speakers who have not come here. We are very thankful to them because they are presenting at an environment that requires time, effort, and energy. And of course, the staff of the Central Bank of Argentina, Palacio Libertad, members of the organizing committee, day after day, going the extra mile. Remember that we operate a central bank that is facing interesting challenges, and we are now devoting our time, our bandwidth time, requires effort and additional commitment from all the staff. This is the first time that we are organizing an event like this in this place, which has been originally designed for short events, music performance and musical concerts. So, of course, we have rigorous rules. We have to abide by those rules. Please do not come to this room with beverages and food, and please try to abide by all these rules so that we can keep on organizing events here. And as regards the orderly arrangement of panelists and concerning Q&A sessions, we are not going to have answers from the audience to the panel. So our central bank research, economic research division members have prepared questions to be asked to the panelists. But if you come across any panelist while we're having coffee, please feel free to ask your questions to the panelists during coffee breaks. And this is all. I hope that you will enjoy this event very much, that you will learn a great deal from it, and that we will be able to recover elements and insights that will help us have a much more prosperous economic progress. And now let's start with panel number 1, central bankers and their insights.
We thank the governor of the BCRA and we invite him to be part of the first panel as moderator. We have then the international speakers for this panel. We will present the perspective of central banks. Among the topics, we'll talk about the incidence of fiscal policy in the overall monetary cycle. We have Neel Kashkari, President and CEO of the Fed in Minneapolis and member of the Open Market Committee. He also contributed to the creation of Opportunity and Inclusive Growth Institute. In 2014, he ran as governor of California, and he also worked in the financial sector in Goldman Sachs and PIMCO. In the public arena, he worked in the Department of Treasury of the U.S. He supervised the Troubled Assets Relief Program during the financial crisis. He also has a master's in mechanical engineering, both from the University of Illinois, and his MBA from the Wharton School in the University of Pennsylvania. Pablo Hernández de Cos was governor of the Bank of Spain between 2018 and 2024. Currently, he presides over the Consultative Technical Committee of the European Systemic Risk Board. He was member of also the Government Council and the General Council of the European Central Bank, and he was also president of the Banking Supervision Committee. He was part also of international European committees. He has a PhD in economics by the Complutense University of Madrid. He also has a graduate degree in economic sciences and corporate sciences, UNEF, and a law also degree.
English now. So the way this panel is designed to work is we're going to have a short presentation by Neel, a short presentation by Pablo, and then we will open it up to my questions. So whenever you're ready.
Well, thank you. My name is Neel Kashkari, president of the Minneapolis Federal Reserve Bank. First of all, I want to thank Governor Basili. It is an honor to be here with you and with Dr. de Cos from Spain. I've had the pleasure of meeting Governor Basili a few times in the past year as he has visited the United States. This is my first visit to Argentina. I'm excited to see the country during this important economic time period, and also hope to have the opportunity to return again in the future. So thank you for the invitation. I'm going to offer some remarks today about current and future monetary policy in the United States. But I will first briefly touch on some historical context that I think you here in the audience may find relevant to your work as you bring inflation down in Argentina. Let me start by noting my standard disclaimer that the views I offer today represent my own views and not necessarily others in the Federal Reserve System or the Federal Open Market Committee. Now, let me look at U.S. history for a moment. Going back in time, the United States Constitution was first ratified in 1788. It wasn't until approximately 70 years later that the first national currency, the greenback that we are all familiar with today, was issued. It was created by President Lincoln, who introduced the national currency and federal debt at that time as mechanisms to finance his effort to win the Civil War. You know, a saying in the US that you've probably heard is that necessity is the mother of invention, and that is certainly true for important economic institutions in the United States. So in the mid-1860s, the US had both a national currency and federal debt, but we still didn't have a central bank. It wasn't until the US economy was hammered by banking crises and economic depressions in the late 1800s and early 1900s, including a big one, the Panic of 1907, that political consensus finally emerged to establish a central bank, the Federal Reserve, which was created by an act of Congress in 1913. And then I will forward in a few minutes, that in 1979, it took that long until the actual modern independent monetary policy was established in the United States. So a key consideration, and my point of this history just is to show, at least in the US's case, it's taken a long time to get where we are. There have been a number of attempts, starts, false starts, steps backwards, ultimately to get to where we are today. And we think we're in a pretty good place, which I'm going to show you. Now, a key for politicians in the US was ensuring that different regions in the United States were directly represented in the policy process. So they designed, when they created the Federal Reserve, they designed a distributed structure with the Federal Reserve Board located in Washington, D.C., and 12 independent Federal Reserve banks that are spread out around the country. This is not dissimilar to the European Central Bank today, which of course consists of the executive board located in Frankfurt and the individual country banks whose representatives sit on the governing council. I'm sure Dr. DeCos will provide more details about the ECB in his remarks. The Minneapolis Fed, which I lead, which is there at the top of the screen, represents what we call the 9th Federal Reserve District, which includes the northern central states of Minnesota, North and South Dakota, Montana, part of Michigan, and part of Wisconsin. While each of the 12 Federal Reserve Bank presidents represents our individual regions at the Federal Open Market Committee, we each make a recommendation for monetary policy that we think is right for the country as a whole. So I'm not saying let's do something for Minnesota. I'm using my judgment to say what's right for the US as a whole. Now, one of the most important assets of the Federal Reserve that enables us to be an effective central bank is our credibility with the public, including, of course, the American people whom we are charged to serve, and investors around the world. They have learned that we will do our very best to make monetary policy decisions that help us achieve the goals that the US Congress has assigned to us: stable prices and maximum employment. And as I will discuss shortly, the US and international experience provides a strong case for central banks to focus on pursuing price stability as a precondition for robust economic performance. Inflation is an unfair tax on incomes. It increases income inequality. It undermines confidence. When citizens don't have to worry about inflation, spending and investment decisions are less uncertain, and the financial sector is better able to channel savings to borrowers. Now, most importantly, our credibility is supported by the institutional independence of the Federal Reserve from the executive branch of government. While we are ultimately accountable to the American people through their elected representatives, we are not making policy decisions to benefit any political party or any individual politicians. As I'll explain in a moment, this credibility to focus on our economic goals without consideration of politics did not always exist in the US. It took a long time to build that credibility, and establishing it came at significant initial economic cost. But once established, this credibility has laid the foundation for economic prosperity for the last 4 decades in the United States. So let me now look at history. We had a very acute crisis in the 1970s in America of high inflation and high unemployment. In the 1960s, on the left-hand side of your chart, you can see the US enjoyed a period of low unemployment and generally low inflation. Inflation is in the red line, unemployment is on the blue line. And you can see inflation in the 1960s was around 2%, and it started to climb toward the end of the decade. But in the 1970s, when oil prices skyrocketed all around the world, the US economy experienced a prolonged period of what we call stagflation. There were deep recessions, very high unemployment, and high inflation. Inflation climbed almost 6 times, from around 2% to almost 12% in the 1970s. Now, in an attempt to mitigate output and job losses, the Federal Reserve at that time did not aggressively increase interest rates, partly in response to political pressure from elected officials. The academic consensus today agrees that in doing so, the Federal Reserve contributed to an unanchoring of inflation expectations and increased macroeconomic instability, ultimately undermining our own institutional effectiveness. But as you see, let me look ahead now. It wasn't until President Carter appointed a new Federal Reserve Chair, Paul Volcker, in 1979, that the Federal Reserve finally turned its primary focus to fighting inflation. Chair Volcker aggressively restrained the growth in the money supply, effectively raising rates to about 20%, triggering a severe economic contraction and high unemployment. These painful actions, however, paid off. By 1983, inflation had fallen to under 4%. So if you look at the green line on the left-hand side, you can see that the effective policy rate was taken almost to 20%, a dramatic increase. The gray shading are recessions that resulted from those policy actions. And if you look on the right, you can see inflation, the red line, and the unemployment rate, the blue line. Inflation climbed until they finally aggressively addressed it with monetary policy. It resulted in a very deep recession. The unemployment rate went up, but then the unemployment rate came back down and inflation came down, setting us on the path of prosperity for the next 40 years. Now, importantly, President Carter's successor, President Ronald Reagan, who was from the opposing political party, reappointed Chair Volcker, thus endorsing Volcker's approach to using monetary policy to keep inflation in check. This established a pattern in the United States of presidents reappointing Fed chairs who had been appointed by the predecessor of a different party. And that pattern has been repeated now many times in the next 40 years. This pattern was instrumental in establishing the political support for the Federal Reserve to be an independent central bank, solely focused on economic goals rather than on political ones. So now let's look forward. This independence does not mean that the Federal Reserve never coordinates with the government. Indeed, in two major crises of the past 20 years, the global financial crisis of 2008 and the COVID crisis of 2019, COVID-19 crisis of 2020, the Federal Reserve worked closely with the U.S. Treasury Department to design crisis response policies to help reduce damage to the real economy from these shocks. In both cases, the Fed's coordination with the government did not come at the expense of us trying to meet our inflation and employment goals. Rather, the coordination was done to help the Federal Reserve achieve these goals. So although the sources of those crises were very different, in both cases, the U.S. economy faced a weakening economy, a large increase in unemployment, and potential deflation. The Fed and the executive branch of government worked together to support the economy and reduce damage from the crises, thus supporting our monetary policy objectives. Now, if you look what happened after the disinflation of the Volcker era, so the early 1980s had a rapid decline in inflation, and then you basically had low and more or less stable inflation for the next 30 years. You saw in the great financial crisis of 2008, inflation went very briefly negative, but it didn't lead to a deflationary spiral. And then inflation was more or less stable at around our 2% target going into the COVID-19 pandemic. Now, of course, restoring jobs and successfully averting deflation was not the final chapter of the impact of COVID on the U.S. economy. The economy recovered quickly, and then the U.S. and most economies around the world faced an enormous, unexpected increase in inflation, surprising my colleagues and me at the Federal Reserve and most economic forecasters. So what caused the high inflation post-COVID? With the benefit of hindsight, the causes are now clear. First, global supply chains for goods were disrupted by the pandemic and took much longer to restore than we had expected. Second, with most of the services side of the economy closed due to COVID, spending was disproportionately directed at the goods sector, which was already facing disrupted supply. Many workers left the labor force due to business closures and were reluctant to return, in part of ongoing potential health risks. Significant fiscal and monetary stimulus had been directed at the economy in anticipation of an extended public health crisis. When the highly effective vaccines became available much sooner than expected, the need for that stimulus was reduced. And then, of course, Russia invaded Ukraine, sending a price shock through commodity markets all around the world. Each of these factors was likely somewhat inflationary on its own, but combined became highly inflationary for an extended period of time. So if you look here on the left-hand chart, you can see the unemployment rate, the blue, skyrocketed when COVID first hit and much of the services economy in the United States was shut. The services economy reopened, unemployment started to fall, but then we had this, in recent era, unprecedented surge in inflation in the US that surprised me, surprised most of my colleagues, and many economic forecasters. But you can also see it turned around, it felt long, but it actually turned around fairly quickly, has now come down fairly quickly. So what caused the fall in inflation? Well, in response to the increase in inflation, the Federal Reserve and most central banks around the world raised rates aggressively to bring inflation down. You can see the federal funds rate on the right chart was around, you can see 1.5% before the pandemic, went to 0 during the pandemic, and then we raised the policy rate north of 5% and held it there for an extended period of time. Now, historically, such a large increase in the policy rate had often led to recessions, like what happened in the early 1980s that I showed you, when Chairman Volcker raised rates, created a deep recession in the US. But in this time, inflation fell while economic growth was sustained. How did this happen? While we're still in the final stages of bringing inflation back down to our 2% target, it seems clear to me that substantial progress was made in unwinding many of the supply factors that led to the increase in inflation in the first place. Supply chains were eventually restored. The services economy was reopened, taking pressure off the goods sector. Workers returned to the labor force, and an increase in immigration to the United States led to an increase in labor supply. The war in Ukraine thus far has not intensified further, and commodity markets have stabilized. What role did monetary policy play in bringing inflation down? Tight monetary policy likely did reduce demand for goods and services somewhat, thus helping bring inflation down. But reflecting on the important mistakes of the 1970s, the most important role that monetary policy played was keeping long-run inflation expectations anchored and reinforcing the Federal Reserve's credibility with the public that we would do what was needed to bring inflation down. That confidence was a key factor in achieving what so far has proven to be a remarkably strong labor market with rapid disinflation. So this chart is a chart of that actual inflation that I showed you. The red line is the inflation. You can see it was running 2% or just below 2% going into COVID. Then you had this big run up in inflation and then the subsequent fall. The blue line is a market indicator of long-run inflation expectations. It's what do markets expect inflation to be for a 5-year period, 5 years in the future. And you can see it barely moved during this period. This to me is a demonstration of what credibility looks like that we enjoy as a central bank, that makes us more effective and it makes our job easier, but we have to do our part to maintaining this credibility, and that's what I believe we did so much with the policy rate in the United States. So turning to the future, what is the outlook for monetary policy in the US? The Federal Reserve is committed to achieving our dual mandate goals of stable prices and maximum employment. Today, monetary policy remains in an overall restricted stance, though just how restrictive is somewhat unclear to me. The labor market remains strong. The most recent jobs report is encouraging that a rapid labor weakening does not appear to be imminent. Inflation has come down dramatically from its peak, but remains somewhat above our target. As of right now, it appears likely that further modest reductions in our policy rate will be appropriate in the coming quarters to achieve both sides of our dual mandate. Ultimately, the path ahead for policy will be driven by the actual economic, inflation, and labor market data. So let me wrap up. What are some of the key lessons from the US experience that might be relevant to others around the world, including here in Argentina? First, low and stable inflation is a precondition for long-term macroeconomic prosperity. Second, achieving low inflation may require short-term economic pain to both reduce inflation in the short run, but also to establish institutional credibility so inflation remains low and in control over the long run. And finally, while the individual reforms will be specific to meet the needs of the individual economy, ultimately, the specific institutional structure should be designed as much as possible to endure over a range of economic and political cycles. Thank you.
Me parece, Pablo, que falta la... No, eso está prendido.
Okay.
There we go.
Is it working? Yes. Okay. Well, thank you. Thank you very much, President Bausili, for the invitation. Let me also thank the staff of the Central Bank for perfect organization, and of course to President Kashkari for the excellent presentation, and I hope also excellent discussion after my talk. I will try to provide some complementary elements from, of course, the European perspective. And given the title of the conference, which is about fiscal deficits, monetary policy and inflation, I will try to concentrate on how we have tried at the European Monetary Union to solve these fiscal and monetary interactions. So let me first focus for a few minutes on what was the European Monetary Union framework that was settled back in 1999 to precisely try to solve the potential interactions between monetary and fiscal policy. As you perfectly know, the European Central Bank is an independent central bank that it is focused mainly on price stability. That's the main objective. And very important, of course, this price stability mandate is focused on the European Monetary Union as a whole. So there is a single monetary policy for the whole European Monetary Union. And then there are fiscal policies that are in the hands of national governments, currently 20 national governments that belong to the European Monetary Union. So from the very beginning, it was perceived that there was a certain need for coordination of national fiscal policies and also to set some limits to fiscal policy in order precisely to allow for a monetary regime to work. And this is why from the very beginning there is this clause in the European Union Treaty of prohibition of monetary financing for the central bank. But there is even a no bailout clause for one country or the whole union for any other country that might have difficulties in terms of fiscal sustainability. With this, what it was intended is precisely to countries to focus on guaranteeing fiscal sustainability in order not creating any spillovers, negative spillovers to the rest of the monetary union, under the assumption that market discipline, the discipline that is provided by markets through, for example, higher spreads, might not work always as intended. And this is, in the end, why also the European Monetary Union was created with a very clear fiscal rule. There was a limit for member countries should avoid excessive deficits, and the excessive deficit was defined as a 3% deficit limit, and also public debt levels that should not be higher than 60% of GDP. At the same time, there was a monitoring device. The European Commission was tasked to monitor public finances in individual member states. And of course, there was even a corrective arm of the so-called Stability and Growth Pact, by which countries that violated the rules would be subject to this corrective arm of the SGP, and there might be even, in a extreme case, even sanctions to individual countries. So, in other words, to a certain extent, this legal framework is trying to guarantee that the regime under which the European Monetary Union is working is a monetary regime, a monetary dominance regime, and not a fiscal dominance regime. And of course, the main reason for this were very well explained by President Kashkari is the intention and the perception based on, of course, all the analytical work that had been done in the economic literature that price stability is a precondition for the welfare of our citizens. So that's the framework. How this framework work? Well, it didn't work as intended, and here in this slide what I have is a summary of all the literature that has been produced since the creation of the European Monetary Union, precisely on trying to put some evidence on how the framework has worked. First, fiscal policy has tended to be pro-cyclical. So this means that countries basically have not used good times in order to reduce their public deficits. And in the end, when there was a downturn, there was also pro-cyclical behavior because, of course, markets were putting all the pressure on fiscal sustainability of countries, and this obliged many countries to reduce their deficits precisely in a downturn. Okay? So to a certain extent, one of the intentions of the European Monetary Union was precisely to avoid this type of behavior, so we can say that it didn't work as intended. And then, of course, the second main evidence that is also very easy to be seen is that the framework did not prevent a general increase in public debt levels, and the reality is, of course, it's not only the average of the debt to GDP ratio in the euro area is higher than 60%, but it is also the case that many individual countries, including Spain, France, Italy, have debt to GDP ratios that are above 100%. Third point that I wanted to make on the evidence that we have on how the framework has worked is that putting so much focus on fiscal and debt sustainability, to a certain extent also avoided to pay more attention to other imbalances that might also create very negative spillovers within a monetary union. And this is about private indebtedness, housing bubbles, and of course current account imbalances. And for sure, the Spanish case before the global financial crisis is a good example. Fourth point I wanted to mention is, of course, that from the very beginning, and for some there was an obvious missing element of the framework. The framework didn't have supranational fiscal elements. So, in other words, it was very difficult in such a context with a single monetary policy and individual fiscal policies to have the right policy mix given the macroeconomic conditions in each moment in time. And of course, all these problems in the end became absolutely evident during the global financial crisis and in particular during the European sovereign debt crisis. That in many countries was the origin of it was precisely the lack or the worries that the market was putting on fiscal sustainability. And this is what justifies many legal changes that were made, in particular on the fiscal framework during the European sovereign debt crisis, that to a great extent they have still not worked as intended. That this is why, and I will focus at the end of my intervention on this, they have led to a new change in the fiscal rule that was approved this year. So let me now provide some background on what has happened during the last 5-6 years, okay, in terms of, again, of the monetary fiscal interactions, starting with the pandemic. And probably the pandemic shock, which was a completely exogenous shock to the economy, it provided probably the context for precisely a good and coordinated fiscal and monetary policy response. When mentioning coordinated fiscal and monetary policy response, I should say that it was an implicit coordination. So there was not an agreement, a common agreement. So each part, fiscal authorities on the one hand and the monetary authority on the other, doing their jobs according to their mandates, in the end, provided the right stimulus to the economy precisely to guarantee that such an exogenous but extraordinary and dramatic shock didn't create structural problems or damage to employment or damage to the productive capacity and economic growth of European countries. And this coordinated response, and similar to other countries, was basically monetary policy ensuring that favorable financial conditions were maintained, and this was done given that the European Central Bank was already at the lower bound, and effective lower bound, it was done through non-standard monetary measures, such as the famous PPP, Pandemic Emergency Purchase Program, but also the fiscal response this time relied not only on the individual actions of each individual fiscal authority, but for the first time, there was also a supranational policy action. There was this agreement to have the so-called next generation NU funds, which was a very significant magnitude. That just to give an idea, for the Spanish case, this has represented 12 percentage points of GDP distributed in 6 years. Okay, so if you distribute it linearly, this means a potential fiscal action coming from Europe of 2 percentage points per year. So, which, as you can imagine, it has been of a very significant impact. Has had a very significant impact on the economy. Okay, but again, one point that I wanted to stress that this coordination, it was completely implicit for sure, but it was also an ad hoc response. So there was a need for governments to go to Brussels and to discuss for hours in order to lead to such an agreement. So there was not an implicit or explicit rule that could lead to such a good outcome. And I will come back to this, what for me is a missing element of the fiscal framework in Europe at the end of my intervention. Then we enter, and President Kashkari explained it very, very well, to the next moment in this very recent period, which was the episode of very high inflation, that in particularly in the European case, this was mainly due to a very negative supply shock, coming from the exit from the pandemic on the one hand, but also by the increase on energy prices. You have to take into account that Europe is a kind of an island in terms of is completely dependent on foreign energy. So the significant increase of energy prices is a kind of a deterioration of the terms of trade of Europe. And of course, this led to higher inflation and also to lower activity, to lower growth, also in a context of very high uncertainty. In this context, of course, monetary policy, and very similar to the justifications that has been provided by President Kashkari to the US case, the reaction of the ECB has been very similar, with the largest and quickest hiking cycle in the history of the European Monetary Union, and also with quantitative tightening. So first, of course, the ECB put an end to quantitative easing and then started also to reduce the balance sheet. In our case, mainly the main element for the reduction of the balance sheet has been by dropping the long-term financing operations to our banks. And again, and very similar to the argumentation that was made by President Kashkari, all the evidence that we have is that this has been absolutely critical in keeping inflation expectations anchored. So to a certain extent, the fact that inflation expectations remain anchored is the combinations of two things. For sure, all the credibility that the European Central Bank had gained during its existence, but also it was this very decisive action that was taken that was also necessary in order to keep and to maintain such credibility. On the fiscal front, here we started to have some tensions in terms of the fiscal and monetary interaction, because there was also, under this context, under this very negative supply shock, there was a response by fiscal policy in order to try to mitigate the impact of the energy and also the food prices. Let's not forget also about the food price increase shock, which to a certain extent they help, for example, by reducing VAT tax at the beginning of the energy shock. They help to contain inflationary pressures in the initial phase, although, of course, once that they are eliminated, are creating also inflationary pressures, because, of course, VAT move up again once it was considered that energy price shock was ending. And perhaps what it was more important, it was also the focus of some analysis that was done by the International Monetary Fund, not only for Europe, but for the whole world economy, that many of the measures that were taken by fiscal policymakers were not sufficiently selective, not sufficiently targeted, which in the end resulted in a too expansionary fiscal impulse, and to a certain extent it made the life of the monetary policy maker of the European Central Bank, in this case, more complicated. Okay, so the expansion that it was created, the support that it was creating to the economy, it was too high. Yes. Now, then, the next episode in this period has been, of course, the reduction in inflation. But before entering into this last part, let me also focus one element that it is particularly relevant for the functioning of the European Monetary Union. So many people were expecting that such a significant increase in rates in a very short period of time might have triggered a significant increase in spreads, in sovereign spreads between member states. And the reality is that it has not happened. My own view that this is a combination of factors that have to be taken into account. And some of them are more of an exogenous nature, some of them are more related to how monetary policy has been implemented during this period. On the first group of factors, you have the realities that some countries which are currently very highly indebted have been those that have also been showing higher growth. To a certain extent, this can be seen as we were lucky, and Spain is one of those countries, while other countries were much lower debt to GDP ratios, public debt to GDP ratios, have been underperforming as compared to the average of the euro area. So this means that it didn't trigger a very significant increase on spreads because of this reason. There was also a decision taken for several years by treasuries, national treasuries, a very significant increase in the average bond maturity, which meant that the impact of the higher interest rates was also very much smooth over time. It took a while, and it's taking a while for these higher interest rates to imply higher interest payments because of this increase in the average bond maturity. There was also the perception that the fiscal framework, after these NGO funds that I was mentioning had been strengthened, to a certain extent, if there was a problem again with the spreads, there might be also a reaction by Europe. And of course, this is a very important factor, this has also taken place in a context on which there's been a risk appetite, very high risk appetite by investors at the global level. But then I think we have also to take into account two other factors that are more related to the ECB policy actions that to me have also played a very significant role, precisely in order to avoid such developments in terms of the spreads and the increase in the spreads between member states. The first one, which is also, by the way, how monetary policy has been working in the US, is that the reduction of the balance sheet that there could have been an origin for the increase in the spreads has been done in a very predictable and gradual way, precisely because, well, it was the first time that many of central banks were doing QT, and we were to a certain extent worried about the reaction of the markets to these developments, and we wanted to be very predictable, and therefore very gradual, precisely in order to avoid these problems, also in terms of liquidity in the market. And then second, and this is very specific to Europe, the European Central Bank announced in July 2022 this transmission protection instrument with the main objective on trying to guarantee that monetary policy is transmitted equally in all individual countries within the European Monetary Union. Okay, so the objective is that the transmission of monetary policy is done in an homogeneous way in order to preserve the transmission across the whole European Monetary Union. How the TPI work? Well, basically, the European Central Bank can announce possible interventions in the market by buying bonds of individual countries, or, of course, moving from announcements to actually buying those assets in order precisely to restore confidence and prevent destabilizing rate spirals that, in particular, in a context of European Monetary Union on which there is a lack of a common fiscal action, could be particularly relevant. I'm very much linked to the framework that was defining at the very beginning in order to ensure that market discipline was there, so that we avoid the kind of a movement to to a fiscal dominance regime, the European Central Bank set some limits or some conditions in order for the European Central Bank to be able to purchase under the TPI. The first is that the instrument can only be used in countries that pursue sustainable fiscal and macro policies, and then the second, that the ECB cannot counter persistent tensions that are due to country fundamentals. So in other words, the interventions of the ECB can try to counteract the increasing spreads that are not focused on fundamentals, that are not based on fundamentals, and only if the country that is affected is pursuing sustainable fiscal and macroeconomic policies. Well, the fact that there was the forceful action of the ECB has not triggered a significant increase in sovereign spreads between member states is, to me, critical. It has been absolutely critical, a kind of a precondition for the ECB to be able to increase rates to such a large extent and so avoid the anchoring of inflation expectations and ensure price stability. Well, the reality is that, given all the evidence that I was providing before on the problems in terms of the implementation of the fiscal framework, a new fiscal framework has been approved, and it was approved by the European Council at the beginning of this year. I'm not going to enter into the details. Maybe later in the discussion I can be a bit more explicit. But the main elements of the new framework is that it puts all the focus on debt sustainability. So there is a debt sustainability assessment that, of course, requires trying to anticipate what the evolution of R minus G is for each individual country, which I think is a very positive development in terms of the fiscal framework, because it recognizes how growth and growth-enhancing reforms, including, of course, structural reforms, affect fiscal sustainability. That it provides also a kind of an incentive, not only for fiscal consolidation of individual countries, that of course is critical in order to guarantee fiscal sustainability, but also it motivates, it creates an incentive for structural reforms in individual countries. And there is also an intermediate target that it is defined under a kind of expenditure rule, that it has been also very positive in other fiscal regimes, precisely because, an expenditure rule doesn't mean that countries, that we are setting a kind of a ceiling for expenditure. It's simply that when one country is defining the budget for the next year, and assuming, for example, that the initial position is a balance position, a fiscal balance position, if it wants to increase expenditure over what the evolution of nominal GDP would say, it will have also to provide a tax increase in order to finance this additional increase in expenditure that is not related or is not linked exclusively to the evolution of the economy. In the end, of course, to what extent this sustainability focus plus the expenditure rule will provide for a more sustainable fiscal policy, more sound fiscal policy in individual member states in Europe, it will depend very much on its effective implementation. And this is why it is now absolutely critical, in particular in the first year of its application, that it will be 2025. It's absolutely critical that all countries comply with the new fiscal framework. Let me say what I think this will mean in the following 2 years, and also very much related again with the interaction of monetary policy. Given the elevated levels of public debt in many countries, the implementation of this new framework will result clearly in a restrictive fiscal policy. And this has already been estimated in around 0.5 percentage points of GDP of fiscal consolidation in each year, okay, in the next even 5 years. And you have to take into account that this will be happening in a context on which the macro projections that are provided, for example, by the European Central Bank in September, are compatible with the European Central Bank reaching its 2% medium-term inflation target in a stable manner already in 2025, and of course also in 2026. So one of the questions that is already emerging in Europe is to what extent the implementation of this new fiscal framework, that in the end, as I was saying, will require a fiscal restriction in the next 4 or 5 years, will put inflation below our target for a while. That's one of the big questions. Well, in this regard, I think what it is important to say is that, when you use any macro model, it is true that 0.5% of fiscal adjustment for Europe would mean lower growth in the short run and also a lower inflation. But if you allow for the monetary policy reaction, in the end, the impact on the economy is not considered sufficiently significant. We have also to take into account that it is very important the composition of the adjustment, that it is we have not only to look at whether the structural deficit is going to be reduced, but also to what extent this is going to be done through revenues or expenditures. And we know that the composition of the adjustment might matter precisely in terms of the impact on growth and also on inflation. That we have all these NU funds that I was mentioning before and that will be present till 2026. Precisely, they can be used to compensate for the negative impact of the restriction of individual national fiscal policies on the macro economy. And of course, I think it's also important to emphasize, because this is one of the main motivations of the fiscal framework, as I was mentioning, that if this fiscal restriction in the following years is accompanied with adequate structural reforms, they could also imply higher potential output growth and lower R-G, helping to fiscal sustainability in this way. And let me just mentioning what I consider the main missing element of the current fiscal monetary framework in the European context, which is related to the lack of central fiscal capacities, which in the end we don't have this central fiscal capacity. In the end, this means that it is very difficult to achieve the right policy mix at each cyclical moment in time. The Draghi report, the so famous Draghi report, this is a report that has been published a few weeks ago, made a strong point about using common fiscal instruments in order to finance some public investment needs, very much related to climate change, digitalization, and defense, for example, that can be considered clearly common public goods. Well, if we combine, on the one hand, the need for having an instrument, a fiscal instrument that would provide the right policy mix, monetary and fiscal in each moment in time, with this more structural element that it is considered in the Draghi report, this is something that we have to consider if we want to have an European monetary union that works properly. And with this, Santiago, I will end. Thank you.
Thank you. Thank you very much, both of you, for your presentations. Let me, I'm gonna bring some questions up. If you have questions for each other, you have to ask for my permission. Let me start with institutionality, given the announcement of the Nobel Prize, and this is something that you both touch upon. It was very interesting to hear the governance for how you, as a board member of one of the Feds within the Fed system, make your decisions. You mentioned you look at the country as a whole and you don't have like a constituents that you need to report to. But Pablo, what about the ECB? When you were governor of the Bank of Spain, you sit there, and your constituency is probably much better defined than in the case of the Fed system, where you even have a series of different regions or states that are not even evenly distributed, right? But in the case of the European Central Bank, you clearly represent the Spanish interest. And maybe what accommodates in terms of policy, monetary policy, Europe as a whole does not necessarily accommodate very comfortably Spain. How do you deal with that conflict of interest in that role?
Yes. Well, the conflict of interest is solved legally. It's when you when you are appointed governor of one individual central bank, the contract that you sign, it is in the contract is very explicitly said that when taking your positions on monetary policy, you have to think for the euro area as a whole. I have to confess that in my 6 years of experience as governor of the Bank of Spain, I have always had the feeling that this has always been the fact. So that all governors, the 20 governors of the individual central banks, of course, the board members, the 6 board members that are seated in Frankfurt, are always thinking about the euro area as a whole. What it might have had also this potential conflict of interest that you were mentioning, Santiago, what it has probably had is other consequences. And there has always been a discussion in Europe to what extent the minutes, the accounts of the monetary policy discussions had to be published, including the individual positions of the governors. And to me, I've always been against this publication with individual names precisely because it can trigger a discussion on what a governor of an individual central bank that may be the monetary policy in such in a specific context that it is the right one for the euro area as a whole might not be particularly good for the individual country. It might receive a lot of pressure. But in terms of the real conversation and the real actions that the Governing Council has had during my term as governor, I mean, this mandate of looking at the euro area as a whole has always been fulfilled by all members of the Council.
It's interesting because you mentioned that during the last cycle of increasing interest rates in Europe, one of the concerns was that it would translate into higher spreads, higher financing costs for the governments and for the companies in each of the countries. And successfully, that didn't happen this time around. But there were other periods in which that discussion was much more challenging. There was a period in which Spain was included into a group of countries that people refer to as pigs.
Yes.
And the cost of financing was not the same for each of these countries, for each of the European countries. I wonder whether that institutionality, that governance was ever challenged, whether some regions in Spain maybe decided, you know what, why don't we print our own currency? Or why didn't you get a call from the governor of the Bank of Italy saying, Paolo, these rates are killing us. We have to do something about it.
Well, the reality is that maybe Spain is very specific, okay? Because
let me complement. Sorry,
yes.
Let me complement the question with the whole membership of the euro question. When Spain decided to become a member of the euro, it must have gone through tough decisions in terms of independence on policy, independence as a central bank, adjustments that he had to go through. Giving up a currency is probably a very complex decision, right?
Yes. No, the reality is that the support of Spanish citizens to the European Monetary Union has always been very, very high, including during the global financial crisis and the European sovereign debt crisis. And to me, this is a combination of two factors. One is a more historical, political, sociological dimension, and the second is a more economic one. The first one is, well, the fact that you know the Spanish history. For us, Europe, to a certain extent, in the image of all citizens, is freedom. Okay, it's democracy, and this is still the case. It's very strong, the perception, no, that to a certain extent the connection and moving to democracy in our case was also very much related to forming part of Europe. Okay. And then the second one is an economic reasoning behind this position is that, and the Bank of Spain, by the way, contributed a lot to this perception, which is that most, if not all, the problems that the Spanish economy was facing during the global financial crisis were of a structural nature. And therefore, one could not say that a monetary policy could solve them. They require, I mean, Spain reached a current account deficit of, it was above 10% right before the global financial crisis. Debt to GDP ratios of the private sector of both households and corporates was well above the euro area average. housing prices, all the estimates that we had, were showing a clear prices being clearly above the fundamentals. I mean, these were issues that could not be solved by monetary policy, but to a certain extent, the problems of the Spanish economy were due to the loss of competitiveness during our first years in the European Monetary Union. And this message, I think, it was understood by citizens, and they were putting the pressure on politicians in Spain and not so much in the monetary policy that was decided by the European Central Bank. And again, I think the Bank of Spain made, I think, a huge effort in providing this analysis to citizens, and I think it was also very good to keep the cohesion and the support of Spanish citizens to the European project.
And going a little bit more into fiscal dominance and combining the experience in the US and in Europe, in particular the QE period and the unwinding. In Argentina, we had a period of QE, but for different reasons. We had an increase in the size of the balance sheet of the central bank as a way to finance the treasury, as opposed to have the policy rate as the main objective, or the interest rate in the economy as the main objective. Given your experience, what you've seen in both in Europe and in the US, where this policy stance has gone through different political mandates, and you mentioned a deeper interaction, a more coordinated interaction with the treasuries, particularly during crisis periods. Has that ever, has the role of the QE implementation ever shifted, or did you ever feel like politicians were tempted with shifting it towards, okay, here's a tool for accessing to financing that will contribute towards containing spreads, like in the case of Spain? How did that interaction play?
In the case of the U.S., it really was, QE has been a decision of the Federal Reserve and the Federal Open Market Committee as we looked at the data and the goals that we were trying to achieve. So first, the modern day implementation was created in the financial crisis when the federal funds rate had already been taken to zero. And the question was, we were facing a potential deflationary shock and very high unemployment. So if you're facing low inflation and high unemployment, we're missing on both sides of our dual mandate. We need to provide more stimulus for the economy. And so using quantitative easing was a tool to try to drive long rates down to provide more stimulus. But then once we got through that period, 4 or 5 years later, the Federal Reserve actually on its own started to unwind it and did the first QT in shrinking the Federal Reserve's balance sheet until around 2019. And then we've been doing that again, just as the ECB has in recent years. And I guess I would say a couple things. One is that the shocks, the financial crisis and COVID, were obvious and identifiable to everybody in the world. It was not an invention of any politician. These were real. And that's what motivated us. And the data that we were looking at, the inflation data, the unemployment data, that was also very clear. And so it was easy to explain why we were doing this, given the situation that was obvious to everybody around. And then when we made the decision to now unwind quantitative easing and turn to quantitative tightening, it was in a context of very high inflation that everybody could see and everybody could feel. And so I guess I would just say the decisions have always been made by the Federal Reserve officials, and it's always been made in a manner consistent with the clear objectives that we have identified that we're trying to establish. And that's what's enabled us to do it and have it not be used for other purposes.
Is completely equal to what the President Kashkari has said. I mean, all the justification for the ECB moving into QE was, of course, derived from the price stability mandate. We were in a context of very low inflation with some risk of deflation, low growth, and the central bank being subject to the lower bound. So well, it was obvious for everybody that in order to meet the target, the 2% medium-term target, which was at risk at this time of for being permanently below the target, we needed to move into these non-conventional measures. At the same time, it's also obvious that there were some analysts we cannot deny that they were emphasizing that this movement towards QE could create some risk of fiscal dominance. Okay, like we cannot deny that. But to me, the actions that the European Central Bank has been taking during the last inflationary episode, the fact that the ECB we were in a position to increase rates in a very significant manner in a very short period of time, moving, of course, from QE to QT also immediately. To a certain extent, it has completely eliminated those perceptions of a potential risk for fiscal dominance. Because again, all those decisions were taken because of the need to guarantee our price stability mandate, independently of what this might cause, the implications this might cause for the fiscal authority. So again, as I was emphasizing at the beginning of the presentation, the framework that we have in Europe is one that it is based on monetary dominance. And to a certain extent, or to a great extent, this last episode has been a clear example that this is the case, independently of in certain circumstances the ECB has to move to non-conventional measures because it is at the lower bound.
No. Let me ask you. Let me ask you about policy transmission mechanisms. And reading your latest essay, Neel, you mentioned that in the essay you mentioned that the first quarter of this year there was a concern that inflation had might be suffering from some type of floor around 3%. Maybe we have a similar discussion here in Argentina, whether it stalls, whether there's some inflation inertia that will create a floor to inflation, and whether we're going to be able to break that floor. And it was interesting to read that you felt the risk in the first quarter, and fortunately you broke through that floor, and you're much more comfortable with where you are today, and that gave you room to argue for a 50 basis points reduction in policy rates. What do you think would have happened if the floor had remained in place? What kind of tools do you think you might have been able to use in that context? And let me tie this into a little bit, if we can, the analysis of a forward-looking analysis, in the sense that there is a concern that an easing cycle by the Fed might not necessarily translate into the interest rates in the economy as a whole, because concerns around the fiscal prospects might keep treasury rates higher. So how do you deal with this risk of transmission mechanism, alternative tools, and how do you, where do you focus in terms of this interest transmission mechanism?
It's a great question. Underlying your question is a key concept for monetary policymakers, which is, where do we think the neutral policy stance is? Which policy stance neither stimulates the economy nor restrains the economy? We don't know exactly where it is. We cannot measure it exactly. We can try to estimate it. And we really know where it is only based on how the economy is responding to our policies. So the fact that we raised rates so aggressively and we didn't crush demand in the US economy and didn't lead to high unemployment told me that the neutral rate in the US has probably gone up relative to where it was before the pandemic. So the analogy would be, instead of pressing both feet on the brakes, maybe we were actually only pressing one foot on the brakes. Now, the big question mark is, so in the first quarter of this year, when inflation looked like it might be stalling out, it was raising concerns in my mind, maybe policy is not as tight as we thought it was, and might we need to do more? So we always left the door open that if we needed to take the policy rate higher, we could take the policy rate higher. But before we did that, we said, let's just give it more time and see if our current policy stance is enough to break through the floor, as you said. But in terms of, now you get into, the U.S. government is running large deficits. If you look at independent forecasts of U.S. government debt by the Congressional Budget Office, they just go up and up and up. What will happen if that materializes? Likely it'll be more expensive for the U.S. government to fund itself, to borrow at higher rates. And that means effectively you could think of our neutral rate will be higher. So instead of, once we get through this pandemic reopening and we go back to whatever is normal in that environment will likely be at a higher interest rate environment than normal before the pandemic. But there are enormous question marks about all of this, and we're trying to feel our way as we go.
I have two more questions. One is complementary to this one, which has to do again with transmission mechanisms. Most of the discussions we've had in different forums about interest rate transmission mechanisms, other central bankers look at their impact of interest rates on disposable income, and mainly through the mortgage market. We don't have a mortgage market in Argentina. So from that perspective, our transmission mechanism is quite affected. It's quite weak. I wonder whether maybe in Spain, the speed at which the mortgage market developed or the timing, because the US has had a very well-developed mortgage market for a long time, whether that ever had a role or not, whether you could identify other transmission mechanisms for the interest rates. And I also wonder whether at the time of making monetary policy, there is a social angle to it. If you're affecting disposable income, should you, as a policymaker, maintain an objective towards the social impact that this might have?
Well, the reality is, and in particular compared to the U.S. case, is that of course when analyzing the monetary transmission of monetary policy in Europe, you have to take into account first that the main financing instruments of our households, but also of our firms, is the banking sector, okay, as compared to the U.S., in which the capital markets play a much higher role, and then. When you look in particular to households, in some countries, and Spain is one of them, a very significant part of the mortgages are subject to variable interest rates. And I will link this also with this more social issue that you were raising, Santiago, at the end of the question. What this makes is, of course, that any change in interest rates from up or down, the transmission on households is very significant. Okay, at least for those that have a mortgage at variable rate, and this creates a certain difficulty also within the European Monetary Union, because Spain is at one extreme. Our 75% of our households, those that have a mortgage, are at variable rates, while in the case of Germany, for example, basically 100% of the mortgages are at fixed rates. No? So it creates an heterogeneity on the transmission of monetary policy within the monetary union. And of course, linked to the last part of the question, it creates also some difficulties in terms of the communication. And in particular, when you are subject to a negative supply shock as the one that we've been facing. Because on the one hand, what you have is that households are suffering for the increase in inflation. In particular, in this case, since it was food and energy, this was affecting even low-income households more in relative terms to rich people, if you want to put it this way. And on top of it, you are increasing interest rates for very good reasons, for sure, in order precisely to keep inflation expectations anchored. And this is sometimes not very easy to communicate and for people to understand. So it creates a challenge, but in my view, it cannot it cannot lead to a policy conclusion that it is different to the one that is related to your mandate. It creates a difficulty that, again, I'm stressing this point because it creates a difficulty that it is heterogeneous across European countries. It's more a difficulty in Spain than in Germany. In fact, in Germany, you can even claim that for households as an aggregate, the increase in rates has been even positive in terms of disposable income. But we have to manage these communication problems in our own way. And by the way, I think this is also why I think that the fact that we still keep central banks that are relatively powerful within the system is good, no? Because then you can have the Spanish governor as focusing very much on this very specific problem, which is a problem of communication, that still, even these heterogeneous effects, the decisions that are taken by the ECB commonly are the good ones for the economy.
So my final question, and a little bit forward-looking as well. The current context in terms of monetary policy frameworks is the one where we never had so many countries implementing such a similar structure, meaning inflation targeting as the main policy framework for monetary policy across the world. At the same time, I don't think we've ever seen, definitely not in this recent era, a situation where every country in the world is hit by the same shock with the COVID crisis. So what we saw was the most coordinated response to shocks from the policy side that we've ever seen. So the initial easing of monetary conditions was, coordinated or not, was correlated. And then as inflation picked up, the different central banks started increasing rates, also in a quite coordinated fashion. And now we're at a new inflection point. And I get the sense that that coordination that we saw with rates coming down and then coming up is starting to break up a little bit, because you now, as it comes to face different challenges in terms of economic performance, you start facing the differences between the structure of the economies and the mandates that they have. So the Fed has a dual mandate, inflation and unemployment, while the ECB doesn't care about unemployment. It only cares about inflation. And the economic structure of the different geographies is different. One is more productive than the other one. One may be more focused on goods, the other one on services. So that coordination, it feels like it's going to start breaking up. So two-pronged question. One is, are you affected by, at the time of defining monetary policy, are you affected by what's going on in the other geographies? Does the Fed look at what's going on in Europe and what could happen to currencies, trade, and other variables if this coordination is broken? And two, the world has changed in the last 5 years in terms of technological development, in terms of financial development, in terms of lessons learned and behaviors. So as an example of what we observe here in Argentina, we've gone through a cycle of demonetization of the economy between 2019 and 2024, and the economy is being remonetized. But with all these changes, we don't know where we're heading to. We don't know what the monetary base is going to be relative to GDP in the next 2 years, because we don't know if our historical parameters are relevant or not. So I wonder what type of challenges you feel you're facing in this new cycle at the time of making policy decisions, given the things that might have changed. What comes to my mind, for example, is in the US, maybe the employment market dynamics have changed through the COVID crisis. And so your historical parameters don't necessarily apply this time around. The fiscal front might be different. Europe has come up with a new set of rules because it realized that it faced different challenges, and the distribution of those challenges has also changed. In the past, it was the I don't know, poorer, but the PIGS, for example, countries versus France this time around, right? France and Germany, where do they stand? So what can you share about these two things?
Well, first, we absolutely pay attention to what's happening in economies around the world because they affect the United States. Ultimately, our charge is to set monetary policy to achieve the goals that the Congress has assigned us. But the rest of the world affects us, and so we care, we pay a lot of attention, we have a lot of dialogue, especially our folks in Washington have a lot of dialogue with our counterparts all around the world. So we definitely care, we definitely pay a lot of attention. But ultimately, we have to set monetary policy for the US. I think you're right, looking forward, that there's going to be more heterogeneity of individual monetary policies of economies around the world. And I think that's a good thing. I think that means that these global shocks are fading into the background, right? The COVID shock, the supply chain shock, the war in Ukraine affecting commodity markets, these were all globally experienced phenomenon. So it's not surprising that central banks would respond to those similarly. And you're also correct that the fundamentals of the economies are quite different, and therefore their monetary policies should reflect that. To the open questions, it's the ones that you said. What does the next 10 years look like? In the US, you mentioned COVID. One of the things that's happened in the US is individuals' demand for housing has gone up. People moved somewhat outside of cities because they could work remotely. They were working from home. They wanted more space. All of this maybe has led to a permanent shift in demand for housing, and home prices are a challenge all across the country. That home prices are high. There's not enough supply coming online. A lot of American consumers are feeling the pressure of that. So have those consumer preferences changed permanently, or have they changed and will they go back? And then what I mentioned about the neutral environment. We think that what sets the neutral rate are demographics and productivity development. Well, demographics in America are pretty clear. Our society is aging. It might shift with the change in immigration, but it's basically on a path you can see. And then productivity growth is an open question. What impact will AI have on productivity of economies around the world? I have no idea. I hope it's positive. I think social media was a productivity killer. So I'm hoping that AI is a productivity boost. We'll see. But if productivity is boosted and there's a lot of places to invest and earn good returns, the neutral environment will go up, and that will affect the stance of how policy is set as well. So there are big questions. You're facing them in Argentina. No doubt our colleagues in Europe are facing them, and we are facing them as well.
Yes, well, on the first part of the question, very similar to what President Kashkari said. Well, in our case, in the European case, you have to take into account that Europe is the more open economy in the world, more even than China. So this means that even if you follow the typical pattern of a monetary policy decision, that you have a forecast provided by the staff, and then you analyze all the rest of the data and you take a decision. The first element of the discussion, which is the forecast, when you have to provide a forecast for GDP and inflation for the euro area, one of the critical elements is, of course, what's happening with GDP growth and therefore on imports and exports in Europe and in the rest as related to the rest of the world. And for sure, the fact that we are now having more common shocks and global shocks probably doesn't mean that we have to coordinate more explicitly our policies, because just following our mandates, probably this implicit coordination that I was also mentioning between fiscal and monetary is already happening between central banks. In any case, of course, there are always very good conversations in international institutions, IMF, BIS, etc., and we can share all the information that it is needed precisely to be sure that we take into account the decisions that we understand and we take into account the decisions that are taken by others, but of course respecting our mandate, which is a domestic one. And then on the second question, I mean, I think this is going to be the focus, probably in 2025 of most central banks, because I think the Fed, but for sure the ECB, are entering into a review of the monetary policy strategy. In our case, for example, the one that was published in 2021. And I guess one of the main issues that the Council will be doing is, of course, taking stock of what has happened during the last 3-4 years, but at the same time trying to incorporate the analysis of new elements. No? And to me, there are at least 3 issues. I'm very much related to what has happened, but I think to a certain extent we will remain persistent in the future that will be relevant. The first one is that is the very high level of uncertainty that we are facing, that I don't see this vanishing. And this has very clear, very strong implications for monetary policy decision. So just to give one example, when the Governing Council of the ECB is now meeting, there is not anymore one only central scenario of macro projections, but there are sensitivity analyses of many different shocks that might happen. Okay, and then the staff basically identifies in each point in time what the potential shocks might be, and they run their models and they show the Council the potential implications. And it is for the Council to give a certain probability also to these other non-central shocks and a scenario. This is a very different way to take decisions as the one that we were having just a few years ago. The second is then the prevalence of negative supply shocks. Probably we economists, we have not paid sufficient attention in the past to supply shocks in more in general. Well, to a certain extent, we have learned also a lot during the last 2-3 years on the transmission of these shocks to the economy, the persistence of these shocks, and the implications of these effects on monetary policy. And we have to take stock of that and to learn. And then the third point is about the magnitude of the shocks. Again, I think in the last 3 years, some non-linearities were observed because the shocks were very significant. They were very, very significant in terms of the pandemic, for example, but they were also very significant in terms of the energy shock and the food price shock. In the European case, we have evidence, for example, that this affected how firms change their prices in a very high inflation. You've been living in a very high inflation environment. Probably we have to learn something from you on how the economy, the agents, economic agents, firms and households behave in such a context, and try to incorporate these non-linearities into the decision-making process, just to mention a few of them.
Well, thank you very much. It's been extremely interesting. We cannot express how much we appreciate you joining us and you sharing this presentation today. We hope that you enjoy the rest of your stay and the rest of the panels.
Thank you very much.
Thank you very much.